this week we want to with that question we are doing. There was a question we are doing from the past paper. It was a question from I think April 2023. We were doing about performances. Okay, somebody's at home enjoying something. Anyway, the last time we met here, we had introduced the performance issue, and I think we had started with what is called the ratios, and we were already going through the process, so we were already done some demonstration, and if we were focusing on a question.
Mama.
So I would like to continue where we left it. So if you are not here the last time, I think generally we are doing what is called performance. And I said performance is something that is applied across, everywhere that business is. So it is something covered in reporting. It is also covered in other areas like managerial finance. So you should know performance is covered in the areas of that areas, is it? So we were going through performance, and I think one of the areas we had started with there was dealing with what is called ratios. Just to give you a background of what we were doing, we were doing what is called ratios. Ratios, and I said last time, are applied, are applied all over. Ratios is not the first time you have heard about it, I'm sure. You may have heard about ratios in financial reporting, in managerial finance. Ratios are also used as a benchmark of performances. And even those who are doing maybe corporate finance, you may know that also ratios is used in those areas. So anyway, just to give you a background, we had, if you remember, just let me admit some people. If you remember, we had said what is the importance of finance to track performance, to give you more information on the future, strategies. You can plan once you know your performance, how it is, and you can easily know how to reorganize your resources for the next coming future. So that's what performance assists us in tracking, of course, how the resources, people have invested money in the resources in what is the business. So they would want to know how it is performing, the resources they invested in. So it assists us to move ahead and know the tracking performance, identify what is our weaknesses and the strength to improve on them, and probably make some informed decisions as required by whatever it is. So we've gone through that. We went through various form of ratios. There's what's called ratios. We explain what is performances. Mostly performance is in quantitative, but there is performance also in non-quantitative, which is called non-financials. Like I explained, there is issues to do with the BCGs, the business reengineering, which is strategic issues. We have all those issues, PISA moon block, and all those which are part of also what is called non-financial balance scorecard and etc. They are also part of what complements the quantitative factors we get to go through here. So we had gone through ratios. We had gone through profitability ratios. Just to remind you before I go back to the question I was doing, we had mentioned there is a leverage ratios, liquidity ratios, profitability ratios, and I give I'll share this later on probably. I hope I remember, but remember, of course. So the idea was that we had gone through that, and in the process of going through all that, we were supposed to at least understand what is liquidity ratios, which we went through. And even in the question which was set in, if you check the question which was set in April, if you didn't know also those ratios, you may have an issue about them. But the ratios are very easy to remember. As you notice, they are categorized into, ratios are basically relative measures commonly. And in most times, they are categorized into profitability, leverage, and liquidity. And of course, we have activity ratios, which are also there. So we have all those ratios which are used to, of course, assess and measure how performance is being gauged. So from there, I think that's what we were doing last time. And in the process, this is the types of ratios we went through. We have that. We had profitability ratio, leverage ratios, and I had added this here as a picture, which was showing also those types of ratios. These liquidity ratios, leverage ratios, activity ratios, profitability ratios, and we had also those ratios which are related with formulas. So this that's especially want to know, of course, not entirely everything, but majority of the ratios. So that's what we did at that time. And in that process, we had talked about the types of ratios, and even we did some questions, and we did an example from OpenTuition. So after that, what was to be done was a past paper. So we had already started the past paper. So I'd want to go back to the past paper. So I'd want to go back to the past paper and probably, remind you what we're doing. There was a past paper which we are doing here. It is here. Just to remind, this is the problem of doing a question and leaving it in the middle. So the past paper was here. We had already started it. But just to also revisit it, because I think after that gap of around 1 week, you may not remember the basics or what it was talking about. So I'll have to read it again. That's why it's always complicated to start something and then you leave it in the middle. It's always sometimes, but it is better, no problem. We can always go back and cross-check it and check it out and see what it is. So that was set in April 2023 was when it was set. So if you search April 2023, now I've shared with you some, by the way, I've shared with you some Excel which summarizes some of those areas you'd check here, like I was checking ever. So you check all those are there, part of it. So you check that and see there are questions there. There is a divisional performances, there is errors, paternity criteria, all those cases, break-even issues, error cases, expected values, and all that. Anyway, let's go back to that. So there is this here. Was April. This is April 2023. April 2023, there is a required, which we're going through. And I think by that time, we had already started. Actually, it was remaining only like a few, 1, 2, or 3 workings, and then we compile all our statement and do analysis on it. Now, this question required an adjustment first to adapt to certain policies. And then we go back to, preparing a revised financial statements. After getting the revised financial statements, we do now the ratios on it. So it had that. That's what we noticed it was having. So it had an issue to do. You have to revise your reports, which is, first of all, adapt to the new policies which they have been updated. And then after that, we now have an updated income statement, updated balance sheets, and then we go back to do the ratios properly on it, and probably, actually subsequently advise based on the ratio analysis we do. And because here it was to discuss the key areas with the recommendations, and you cannot discuss in this context without having done the analysis. You can't suggest that. So anyway, this was the question, and it was in compulsory area. So you needed to go through that. Now remember, performance is one of the areas which is always tested. Is one of the areas which is tested. And in fact, there was a student who was suggesting we should actually maybe plan on how to do those things which are tested in class more, and then look at check the other things, how to do them. But it's kind of also a tricky issue, because some of the things like ratios, you can easily, there are some things of performances you can easily do online easily than doing, doing like, let's say doing, there are some things like budget, which require calculations. I always, that's what we take to class, like doing those things we do, like life cycle costing, all those issues. Some of them, they require classes, and doing budgets, variances require class, because it needs you to copy the formula, explain the formula, and all that issue. And it has a lot of things to do, even including linear programming, even like linear programming require a drawing of the graph, and all those cases may require physical classes. Anyway, we'll see what it is. Let's try to push what we can push. Let's finish what we have here, and then we push as much as we can. The more hours we allocate, the more hours we do what we can do, the better. Now, this is what the question was saying, to remind, just in case you missed, or in case we need to update ourselves. Also, I need to update myself what it was talking about. So the question was saying, you have been recently hired as a management accounting consultancy in the Ministry of Information, Communication and Technology. The ministry wants to access both financial and financial performances of selected two key companies. There's Rovero Investment Company, which is referred to as RIC, and then there is a 5-generation Computer Corner 5 GCC Limited in the industry of information technology, which will help the ministry during its policy. Then the next issue is financial performances. RC Limited. There is 5 GCC Limited, are known computer and accessory manufacturing companies in Rwanda and in the region for their tight competition, and they both have at least 70% of the computer industry market share. Recent information technology industry faced a downturn due to a downturn due to a reduction of the inputs and abnormal increase in input prices. In addition to that, due to the COVID-19, the demand of the information technology related items, including computers and other accessories, shrank significantly due to reduction of the purchasing power of their clients. This has resulted in the reduction of the set price by 5%. The two companies use financial performances analysis ratio to measure their profitability and position themselves against their competitors, and also making benchmark based on the industrial averages. So there is industrial averages ratios, there is a distinct serial number, and then there is ratio type, and then there is a ratio itself there. So the ratio type, we have under serial number 1, we have current ratio, there is 45 to 1. Then there is number 2 is return on capital employed, also referred to as return on investment, is 45%. And then there is number 3 is accounts receivable days, there's 35 days. And then there is accounts payable, which is number 4, which is 30 days. And that ratio is equals to 20%. So the following are some of the financial statement components. Extract, just a minute, let me admit somebody. From the company's unaudited financial report for the year ended 31st of December, 2022. So there is a statement we are given, which is for the 5G and of course the RIC itself. So there is a RIC and the 5G. There is a column for that. There is of course the common things in the income statement: revenue, cost of sales, blah blah, the operating issues. They are listed on each side: selling and distribution, finance costs, and all that, and there's taxation. financial position, as you know, PP, non-current assets, current, and then the equities and liability sections. So there is the PPEs, the intangibles assets, there is all that, inventories, the receivables. The equity, non-current liabilities, there is also current liabilities. I think you know all those components. And then as we go down, there is also the equity section, or what is called net asset section. So we have all that, which is also given as such. I think I don't need to go into that. There's additional information. So mainly, before we presented our financial revised statement, we needed to understand the new additional information, which was giving some, policies which were supposed to be adjusted in respect to that. And then after that, we have an updated revised financial statements. And after we do that, we do the ratios analysis on them, and we have to recommend based on the outcome we get from the ratio analysis. Of course, benchmarking ourselves on industrial performances. So additional number one was merely talking about the policy of inventory management. They were saying that they prefer to use, the LIFO system, so which we are trying to use that time. So they say the inventory valuation by RIC and 5GCC is FIFO and LIFO respectively. The industrial averages have calculated using, of course, FIFO method. All the methods should be, they wanted us to use FIFO. So they wanted us to use FIFO as it is. All the inventory should be valued under FIFO method. FIFO basically means first in, first out, which is always fair deal. You came first, you get to move out as the first one, or to move out in the process. The first in that came in is the one that is given the priority. So they wanted us to adjust the inventory to that policy, which we were doing last time. I think there's a table which was showing how RIC did the evaluations under FIFO, and 5GCC was doing the FIFO, and LIFO column were given. So we needed to check and see, is the inventory recorded in the statement? Is it under FIFO or LIFO? If it was under FIFO, we leave it because we don't need to adjust it. Remember why we're adjusting? Because we are going to benchmark our performances on industrial level. On industrial level means you are trying to compare within the same industries commonly, or within homogeneously within the same factors across, so that you see where you are. So if you check that, that was the case. So then number two, so basically here it means this was talking about, if you were to elect this was talking about inventory. I've always said whenever there's additional information, the best thing to do, you have to know additional information is talking about something, and something that is being talked about is either something that you need to adjust or something that you need to add on. And those are the two things it is. And you need to highlight them because you need to remember them. Like you need to give them, what I mean by highlighting is giving what is the highlighted subject. Like here, the highlighted subject is inventory. The second highlighted issue was borrowings. Including the borrowing is a loan facility of 950, which was acquired before the year end, specifically for construction of a branch in Msanze. This branch is expected to start its operation in mid-2023. Its related financial cost, amounting to 85 million, has been accurately calculated and included in the financial cost, and its related liability has been included in the trade and other payables. So you notice that the issue here was this. Let me say the issue, what it was here, because we had started to calculate it. So the issue, if you check here, the main issue was that we are in 20, I think our statement was in 20, 22. So while this amount is issued for 2023, so it means there is something we need to adjust that, and that is because of the period. We'll have to factor in that period as a concern. So that is something will be, it's a period issue. Yes, the subject is borrowing. I'll fix that later on. And I think that's what you understand by that, because how do you know this? Because if you check, our report was supposed to be prepared as per the period of 22. And yet, here we have a loan that is for the 2023 that we're receiving. If you check, you notice it's 2022. I'll show you that later. Now, number 3, it is 5 GCC policy to treat the overdraft facility above 15% of the total long-term liabilities as 100% non-current liability. So it's a classification issue. So we'll also be concerned with that as we move down to see how it is. So we'll also check that and see. That is something we will also factor in, or we'll check that and see. Number 4, including the operating costs is depreciation expenses. Included in the operating cost is the depreciation expenses of Frick Limited and 5 GCC Limited, which have been calculated using state line method of depreciation. To compare their results, with that of the industry, a reducing balance method should be used for this particular year instead of a straight line method of depreciation. So there is a conflict of policy. One is suggesting that they should use, actually the one we use, they are saying we use the reducing balance. And currently they have used straight line method. The following is the depreciation. The following is the depreciation has included in the above present statement of financial for profit and loss, sorry, of profit and loss for that case. So here there is a conflict of 2 policies. One is on straight line, the other one is suggesting they should use reducing balance. So we'll have to update our depreciation and move it from the straight line to reducing balance. So reducing balance, the good thing they have calculated for us, reducing balance should be at least 2,250,000. And for the 5 GCC, it should be 4,590,000. While in the straight line, they are suggesting that they had charged 3,750,000. And then there is a 5 GCC had also charged 4,050,000. So we'll have to switch to actually the reducing balance. So if you highlight that, that of course means we're going to use reducing balance so that we can adapt to what they wanted us to apply as per that. So it's a matter of switching from straight line, and then we move to the rest and use what it is. So as we move down there, there is a 10% of the sales have been made on credit. If 10% of sales have been made on the credit for both companies, it was kind of an irrelevant information, but maybe necessary for the future analysis. But we'll keep in our heads that way, because when it comes to income statement, we don't really care whether it's credit or debit, whether it's credit or cash, sorry. So we usually just charge as for the period. When it goes to the balance sheet, maybe it is when it may be a concern. But also the balance sheet, we can't really, kind of specify correctly, because it may have the receivable also from many other years. So that's why I'm saying it is like an irrelevant information to that extent, because when we go to the receivables, we really don't know, the receivables always has overdues. When you do aging analysis, it has due, overdue, and that is the case. So there is that issue, when you do aging analysis, it shows that the receivable may have many than just this year. So we can't really focus on the 10%. But anyway, there is credit purchases for a franc of 5 million, and then there is a 920 for RIG, and also for 5 GCC Limited. So again, here we may use it later, maybe for analysis, but not in the statement. Also this 10%, I said it may be used for analysis, but maybe not for the statement. Assuming a year has 365, they have given studied that question, and I think if you check in the Excel here, I was doing it here. Those who are here, remember that we had already gone through the process. So we had done a statement. Just I was reading to remind you what we're doing. So I provided a revised statement. This is basically for statement of financial position. Let me just try to see how I can work it out. Just a minute. You know, working with the digital platform is also a big challenge for that. So I think everybody has a question. You could check. I always recommend it's better to have a question. You can print the questions and maybe make a folder for them or something like that, or bind them as you try to use them for your own revision. So it kind of assists you. Maybe you need to do thorough revision to be able to make it through. I've always said preparation requires to do more. You know, the more you're prepared, you can never fail if you're prepared thoroughly well. That means you have reduced any chances of any question beating you out, and that is the case. So if you check here, we had done like, so I had tried to put some of the screenshots here, and if you check, there was issues to do the revenue. We had fixed some of the issues, which are here already. So we have all that, which is what was the revenue. We are trying to adjust. Now, last time, if you are here or if you're not here, just to update you, we had gone through all that, and what was remaining was just a matter of us trying to, you know, fix some things here and there. And we are going to try to do that and try to, you know, make sure that it works for whatever it is. So we are going through working one, and we had easily fixed that. I think just a minute. Give me a minute to just fix this. So I'll remove that. Just a minute. So this was our cost of sales, and we had fixed that. Just as I was starting that, we can start again and do a quick review just in case you forgot what we were doing last time. So we started with first of all, making our statement look like this. This is adjusted, you know, an adjustment which was to be made on the income statement. So we had the income statement that needed us to fix. So we had that. This is the company called RIC, which was a Ribeiro Investment Company. And then there is the 5 GCC, which was 5 Generation, you know, Computer Center, which was that. So we had this, and I said this we did in the working. Now, remember, it's not, we did not adjust everything. We adjusted only that what was required. And what was required, if I zoom it outside or zoom it, you know, reduce the zooming, if we check note 1, we were talking about revenue. This was revenues. So revenues, if you may remember, those who are checking revenue, you could check the past paper. Revenue, we have been told that the inventory valuation method by RIC, I think you could see that. If you're double C, you can increase the size. By RIC and 5 GCC Limited is FIFO and LIFO respectively. So it means RIC was using FIFO and the 5 GCC was using LIFO. That is the first sentence. The second sentence, the industrial averages have been calculated using FIFO. So we need, because our comparison or our benchmark is industrial performances or industrial results. So they're saying the industrial results is, or the industrial policy, they use what is called FIFO. So we need to adjust to that. Now it means we can only adjust 5 GCC. Why? Because Rick is already using what the industrial are already adhering to or already using, is it? So, and that's why when it came to what we're doing down here, it is inventory. Now, inventory affects what is called cost of sales. Those, I think you have, all of you are students of also reporting, or may have been students of reporting. So, you know, the cost of sales is merely, or a majority of what cost of sales contains is movement of inventory, especially in a product section or where you're dealing with the goods. So in this case, the inventory here is what we were focused on. Why? It is the one which was the main issue in note number 1. And number 2, we were focused on cost of sales because the cost of sales is the one where inventory movement is tracked. Because inventory movement in the cost of sales, there is inventory movement called opening cost. There is inventory movement which is called purchases, which comes in. You get the total of the two is called goods available for sale. And then what is not sold, we call it what? The closing stock. So we needed to do that. And that's why we did this as a working here. And I think from that time, we went through and we went through all that cases and we calculated what it gives us, which is this. We started by listing all that factors, which is here. I think anybody who could see that, let me put it again here. So if you have a past paper, there was, of course, need to go through and understand how it affected this. For 5 GCC, there was no problem. This was correctly what was done. And if you check, as you may notice, in that case, we had this and that. Not 5 GCC, sorry, RIC. For RIC, there was no problem. But for 5 GCC, we needed to calculate and find what it is. So that's why we went through that. We added, we took what it was for that. There was LIFO, which is here, and then there was FIFO. So for the FIFO, we started with opening because now we need to switch from LIFO to FIFO. And we did that because the closing stock that was presented, was done under what? Because here's the inventory. Here, it was done under LIFO, and you may see it is here, which was not what the industrial averages would use. Industrial averages would use what is called FIFO. So we have to switch this to FIFO. So we introduced that FIFO, and we did that, and we calculated and got what it is from that. Now, the only problem was how do we find, because it was requiring us to get some factors that we needed from that issue, and that was the case. So if I could like maybe, let's do this way first, because I think we're done only 2 workings. I could easily do that probably for a few minutes. The idea was this, we needed to have the 5 GCC to switch because that was the main problem, to switch from LIFO to FIFO. So to switch that, you needed, it was necessary for you to do calculation, so which you can do. We had only done 1 working, and the second one actually we're not finished, and time caught us, and we could not do that. So let's just start it afresh again, maybe for purpose of just making sure. I mean, you know, I know there are some people who have been who have gone away, and maybe they don't remember what we did last time. Let me go through again and try to show you what I did last time before we move to the next working, because we had actually done 1 working. We were supposed to go to a second working. So I can easily start. It's not a big difference. It's a small difference, is it? So this was the case. We had 2 columns. One was to show the FIFO, which is the new, or the one we need to switch to. Then there was LIFO. LIFO was just for formality to show what really happened. Now, if you check through our data, we had all that. So we had already the inventory, which I could bring back again here. It is this one here. Let's take this out. This was the inventory. So if you check the inventory, there was the inventory movement. There was opening, and there was also closing inventory. So which I kind of would use you to notice that. So in this case, we had the opening. Opening was given. Just a minute. Opening was given as this period, and opening was to under LIFO side 284,300. But we also had purchases because I needed to calculate new cost of sales. So the switching of this required us, or will result in us calculating new cost of sale. Let me say that. Don't think it's only a matter of switching. It requires, because the cost of sale cannot be the same under the different methods of FIFO and LIFO. They can never be, it cannot be the same. So we required, it was required, if I say that, it was required, it was required to calculate a new cost of sales, And that's why we had to go through that, because they will be, of course, have different evaluations. So like in FIFO, the opening is 193,300. That is in FIFO. And the purchases, we don't know, because here they were giving only the closings and opening. But for the other part, we'll of course calculate, and also we don't know. Because this one is already in the income statement, we can easily use it. But if you check, it is possible for us to get it because we can get what is called goods available for sale. Goods available for sale. So the goods available for sale is usually a combination of opening plus.
Excuse me, sir.
Yes, please.
The opening inventory under 5 GCC under FIFO is 245,200, I think.
Oh,
you look at the table.
Oh, yeah, it's correct. You're correct about that, 200. So here, there is the purchases. The purchases we don't know. But remember, cost of sale contain averagely 3 components. That is opening plus purchases. You get goods available, you need to sell. Subtract what you did not sell. So like in this case, the opening was that, the opening was this. Thank you for that. So then there's the purchases. The purchases, we could not know for that moment, but we could know that when you have the purchases, there's need for you to less the closing stock, which was the goods that have not been sold. So the goods that were not sold in this in this related issue, the goods that were not sold. If you check, the goods that were not sold were given there, like we are still under 5 GCC, which is the one we need to change, was 8100. I've explained why we have taken the 5 GCC is because if you check in the balance sheet, you will see this. And even if you check in because the balance sheet was showing their closing stock was valued at this, and that's why I took it. So that is also the reason also I'm using it here again. So it is 736,800. So I noticed they must have used LIFO, because if you check the balance sheet of RIC, the one which is in the balance sheet is 486, meaning that they used FIFO. So from this case, I think once you do that, you'll get what is called the cost of sales. The cost of sales. So the cost of sales, of course, is usually the movement of inventory, which means you take the goods available for sale and you take away the goods that you did not sell, and you get what it is. For now here, this should be also, sorry, I think I put the wrong data. it should be summation of what is there, should be able to be dealt with from that position. We don't know the purchases yet. Similar to this, we have all that, including including what is up here. They will give us all that we have. But in this case, this one should be giving a goods of available for sale, which is that. So I was saying again, we can always get what is called purchases. Why? Because it's a movement of inventory. You know for sure cost of sales originally, those who know cost of sales. Cost of sales is usually equal to opening, because there was somebody who was asking me how I calculated the purchases. This is opening, what you call opening stock, plus what you have added, which is called what? Purchases, minus, this usually gives you what is called goods available. So goods available subtract what is called closing what? Closing stock. So if you subtract closing stock, you get what? You get goods available for cost of sales, sorry. You get what is called cost of sales. Goods available is opening plus purchases. You get goods available. You subtract away what you did not sell because it is included in the goods available. So you get that, is it? So I think that is the first thing everybody should notice what cost of sale is made of. Now, the next issue was, how do we calculate purchases? You play along with this. I think, you know, mathematical elements or mathematical things which are connected, how you can easily manipulate and go back to the other one. We can do that. So we can manipulate the formulas to adapt to what could be purchases. So therefore, purchases, now that I have enough time to explain this, so purchases is also usually stock. So don't think I've not put, it is or goods, whatever you may call it. If stock means what is in the stored, you could call it purchase goods, but all of them are goods anyway. Commonly, there are goods. Even this is opening goods. You add purchases, goods, and then you take away that. So purchases in this context, again, it will be like you'll take mathematically. I think if you have somewhere roughly, you could do that. It means the purchases are equal to what? To the cost of sales you have, which is all given already in the income statement. So you take cost of sales. You, of course, need to know how this would work. So the cost of sales will, of course, be given there. And my intention is to find the purchases. Now, if I need to find the purchases, what will I do? Remember, if you've forgotten, you can just do a quick review here, vertically, and see. We are here cost of sales. So if cost of sales, of course, is moving that. So I need to, of course, plus back some of the things and minus some of the things and get what it is, and I get what was my purchases. Now, commonly, I will need to take away what was available, or what was in the opening stock, and of course, what was what. And you add back what was, of course, involved in the closing stock. So it is a reverse of what how we calculated what is called the cost of sales. I think that answers somebody who had asked me last time, how did you get the purchases? The purchases will be, as you may notice, if I want to get the purchases, assuming here it is X value, you can easily know how I'll calculate it. Because it will mean I will, of course, go back or bring this back here to this side, and it will be plus, and all of this other side, including that, will be minus. So the idea will be you minus the opening stock. I think I've explained enough of that. Minus the opening stock, and you plus the what? The closing stock. And that is how I got purchases last time. So if you do that, you'll get what we did last time. I could easily do that. Our cost of sales on the other side was given. If you check the question here, note this, there was an income statement. I think anybody who has an income statement could easily get that. Let me go through that. It is maybe somewhere there. What was the cost of sales? What was the cost of sales? Do you have it? Just a minute. I check, I see. No, I cannot get in any of these slides I've put here or any of that. I don't remember. But if you check, you notice there was a cost of sale. Let me go back to the PDF. There was a cost of sale which was there. And the cost of sale is the one that I'm talking about. Actually, the cost of sales, because I want a quick way to get it, I think I can use the PDF back. The cost of sale in 5GCC, as you may check in the PDF, those who have it, was of course 11,456,810. So that's what it is, 11,456. So you come here and you post it there. So if you scroll down, this is what it was. Cost of sale here was 11,456,810. You need to subtract 280 what? 284. Sorry, 284. Yes, it's correct. 284,300 plus the closing. Closing was 736,800. 736,800. So if you do that, you get what it is. And I think you have seen all the figures. And that is how I got what was my purchases here. So my purchases was equivalent to that. And of course, it gives you the cost of sales, which was that exactly. And then if that was the purchases, because purchases is valued exactly as you buy. Is valued exactly as you buy, meaning exactly as you paid the supplier. The problem is how you manage it in the movement, because they mix. When they mix, they're mixed with opening, and when they mix with opening, the problem is when you are valuing them or when you're moving them out is when the LIFO and FIFO comes in. But how they come in, because they come from a third party, they come in with the one value or with the value which is already known. So that's why the purchases is easy to know and to remain as it is, which is after you have the other factors, you can easily know it. So that was our purchases. And if that was our purchases, this was our closing, then this changed to that. And I believe that is what I calculated, and that is what I got here, exactly that. Unless there is anybody with a question, that was working number one. So working one was giving us that idea of how to calculate this. So if anybody has a question on that, that is what we did, and we got 11,300,000. Yes.
I beg your pardon. Where have you got that cost of sales? Is it in the P&L or it is in the additional information?
It is in the P&L. The profit and loss, I tried to check it here. Let me see. I was not finding the screenshot I did, but I can show you it. I can show you it maybe if I find where that screenshot which I have. But I got it from the profit and loss. There's a profit and loss statement. I think it is. I don't know which number I used it, but it is there. Do you have the PDF? Check it.
Now, my question is, you had said that the inventory valuation methods of FIFO and LIFO affects the cost of sales. But again,
Yes.
it is like the cost of sales has remained the same. What has changed probably is the purchases.
Yes, the purchases, of course, no, the purchases did not change. The purchases did not change. In fact, it is the last thing I'm explaining here. Purchases usually don't change. Or purchases, let me say not usually don't change. Let me use some logic explanation. I think I don't remember where there's a copy which I did, but I don't remember where it is. I wanted to show you that, but it's kind of, I lost it. I'll show you later. So anyway, what I was saying was this. If you check, the purchases remain the same. Why? Purchases, you see, if you're buying something from me, you pay exactly what you agreed, is it? Is it true or not true?
It's true.
Yes. So for purchases, it does not change. What changes is how you manage FIFO and LIFO are about how you manage your inventories. So they affect your valuation of closing stock generally. And subsequently, closing stocks becomes what? Opening stock in the next year. So here, the purchases, if you check, they are the same. There's no difference here. If you take this minus that, the difference is 0. Why? Because purchases come from external agreement. Internal agreement is what is called inventory management, because inventory management is how you manage. If you buy bread, you buy bread like you have bread for last week already in your stock, and you have bread for this week. You see, commonly, it is necessary as a business person, I'd want to sell the bread for last week to go out immediately. That is what is called the FIFO, because the bread of last week may expire this week. So I'd be very cautious to make sure the bread.
So sir,
Something.
what does the FIFO LIFO affect?
It affects it.
Does the cost of sales change, or it remains the same?
Let's do a quick difference. You see, this is the difference here. The difference is here. If you check this minus this, there's a difference. It is not the same. Only purchases remain the same. Here, because overall, this is a movement of what is here. Of course, overall, the goods available will not be the same. Why? Because of the difference which I've got here. And here, also on valuation of closing stock can never be the same, because the movement is not the same in terms of that. So there's a difference here. And subsequently, overall, the cost of sale cannot be the same. There's a difference of almost 113,400. So it changed that way.
There, my concern is the coming in of FIFO and LIFO. We are supposed to do some adjustments, maybe on cost of some adjustments on cost of sales. But it's like there's no adjustments we have made on cost of sales, because we have copied what was given in a P&L, and that's what we are using to calculate the purchases.
Exactly what we had in the. You're correct. There are 3 factors here, but you remember we have to find the missing. The missing was the purchases. Purchases is constant throughout. The purchases is constant throughout. So to find the missing, always they must give you the other variables. So what are these other variables? In the cost of sales, we have 3 common variables. 1 is the opening, 2 is the purchases, and then 3 is the closing stock, which are supposed to be 3. So you see, when you come to the reason why we use the existing data, we need to use the existing data to find the purchases, because the purchases is similar in both areas.
Yes.
So our missing part here, this part here was missing this. Remember, this is given also in the question. I did not calculate it. This one here, the red one, which is the opening stock, is given in the question. Also, the closing is given in the question. I did not calculate it. So only thing I was missing was the cost of the cost of the purchases. And to do that, I have no really option, but only way I can do it is to use the given information, which is this. I had also the opening of that, which is the opening under LIFO, sorry. And I had also the closing under what? Under LIFO. And therefore, I could easily find this part here, because I had the, apart from the, aside from the 3 factors we know, the opening, the purchases, and the closing, I had at least 2. If you have 2, you can find the 3rd one. So the examiner was deliberately giving us those 2 so that you can find the 3rd one. What was the 3rd one? Was the purchases. He gave us the opening, he gave us the closing. So he knew easily you can, when you have the closing and the opening, and you have, of course, the another one, which is purchases, which is the summation of the movement. He had given us 3 factors. So I needed to find only the 4th factor, which was, of course, the purchases. And that's what I did.
Excuse me, sir.
Yes.
When you look at that heading, you are saying that 5 GCC to switch from LIFO to FIFO, it is
Yes.
required to calculate new cost of sales.
Yeah, exactly.
And it is like we have not calculated the new cost of sales. We have just got the cost of sales from P&L. That's what we have got. Where is the
Yes,
new
exactly.
cost of sales?
The new cost of sale is this one here, the one I've highlighted just now in yellow. The new cost of sales is this one here, 11 million.
I thought that is the one from the P&L.
No. From the P&L, if I make even a quick screenshot, the P&L has a different value. The P&L has a different
it had
value.
11.
11,400 and something.
56.
56 something. So it's not the same, eh? It's not the same. It's not the same. I could just do a quick screenshot for you. It's not the same, eh? If you come like here, let me bring it here. If you bring it here, let me show you here. It is this figure here. This is 11, 4, 5.
So now, if you use the,
it is this one here now. There's a slight difference because of valuation. A different valuation brings or makes the cost of sale not to be the same. Different valuation.
I can see that one is the cost of sales under LIFO. So when you go to FIFO, if you go to
the
FIFO,
cost of sale changes. Is to continue.
If you go to FIFO, it's like now you are remaining with two unknowns. You don't know the purchases and you don't know the cost of sales. So how do you get at least one unknown so that you can be able to calculate the second one?
The idea was this. Let me say again. The idea was I have to understand what is cost of sales made up of. Cost of sale is made up of a movement of inventory. The movement of inventory moves this way. You open, you buy to increase what you have. You get what is goods available for sale. You sell, you remain, you do stock taking at the end of the period. And what you remain is supposed to be closing stock. And the difference between the goods available versus closing stock is supposed to be the cost of sales. So it is true what you're saying. We don't have cost of sales, but we don't for the FIFO, but we have cost of sales for LIFO. The cost of sales for LIFO is the one I've just shown you here.
I've seen it. Yeah, true.
It is 11, 456, 810, meaning that I can use that to get the cost of sales, the purchases, sorry. I can use that to get the purchases because in the question I have opening and I have closing. So what was missing was
that means purchases under LIFO and purchases under FIFO, they have to be the same.
They will be the same because purchases, when you think about purchases come from third party or from what you are not having. So they come with they come in the same value. Okay. You see, when you buy bread can be bought in different dates. That is purchases. But how you release bread it depends on how you manage your inventory. And I think bread is usually so, it's something which is called perishable. It can expire under 5 days. So when they sell the bread, you must sell it under at least 5 days or a maximum of 5 days. So it means you must try to sell the older bread, which is the one we call FIFO. FIFO means first in, first out, as compared to selling the new bread, the bread that has come in. So what we are missing was actually purchases. Let's say that way. Once you get the purchases, you get everything.
Okay.
You got the point, eh?
Yes, I got
it. Ahead. That's why I went ahead and given the formula here. If you check clearly, I started by explaining the connection of cost of sales with purchases. The connection of cost of sale is you have opening, you add purchases, you take away you get goods available, you take away closing. I started by explaining that to understand how I will get my purchases. So therefore, mathematically, if I make purchases my subject, meaning that all of the others cross to my left side, then it means closing stock would be plus if it crosses this side. Opening stock, because it's positive this side, will be minus, and you see it is minus here, and it is plus on that side, because so that I remain with purchases on my right hand side, and that means opening will take a minus and closing will take a plus, and it gave us this figure here, and that figure is the one that became the purchases here and there. And if you automatically insert it, it adds this gets goods available, you take this away, you get what is cost of sales. And the cost of sale is changed by here, which is what I have also automatically also updated in that case of that what we have. So anyway, let's move to the next. We can move to the next. Okay, next was note number 2. If everybody is satisfied with that, note number 2 was saying included in the RIC limited borrowing is a loan facility amounting to 950 million, which was acquired before the year end. This branch is expected to start its operation in mid-2023. Full stop. Its related finance cost amounting to 85 million has been accurately calculated and included in the finance cost, and its related liability has been included in the trade and other payables So here again, it is something to think about. Now, if you check quickly our report, which was given, we were to report, I think I can check the date here. The date is not there, but I can take you back just quickly here. Our date was that it was supposed to be, we had a report we were adjusting. The report I'm adjusting is a report of 2022, or what I'm supposed to report. I'm supposed to report on events up to 2022. So 2023 brings something in our mind that we need to question. What do we take and what we should not take? So if you go back again, you notice 2022, December. So if you come back here, you notice that the loan here, they are saying that loan is for 2023. So we cannot charge that amount. We cannot charge that amount of 85. So I need to adjust and eliminate that amount of 25 in all the areas it has been charged. So we agree by that, because this amount is a finance cost that is relating to, or a finance charge that is relating to 2023. And since it is, they are saying it was charged in this period, I need to eliminate it. Somehow, maybe, unless somebody has not understood that. So I'm going to subtract that figure. I'm going to subtract that figure.
How will you treat the 950?
950. I will simply debit cash and credit the loan facility. But for the charges, we can't charge it in the income statement because we are yet to start to charge it. We are yet to start to charge it. It will start in the next year, which is 2023. So we can't charge it as for that. This question was almost like testing on it had a combine of financial reporting and the issue relating to also performances and stuff. So it was a mix of both. So I need to apply that, and I need to apply the accrual system here. The good thing, all of you are also students of financial reporting. So whatever I'm talking about, or if not, you have done intermediate, so you must know the scope of what I'm talking about here is about the related issue for somebody's asking me a question. Just a minute. What do you mean by charges? I mean charges, I mean expenses. I mean expenses generally when I talk about charge, I mean it has been accounted on you or accounted on who is responsible for that. So it is the reason why I'm saying we can't charge it as it is part of 2023. So in that context, I need to prepare how to eliminate it. I need to eliminate 85. 950, no problem. When you receive money, you cannot say, I need to receive this money next year. No, you receive it, you record it, and they account for it as a cash, and you record who gave you. If it is because it's a financing, if it is a liability, of course, you take to the liability and current liability section. I think you know all that, and whatever you may know that, it is what I'm trying to explain. So the reason I'm also explaining that is because you need to understand that for you to be able to understand what I'm about to do on it. And that is why it is important to get that point so that you can easily get to this. So we'll make a way of dealing with that. We can call it working number 2. Just a minute. Working number 2. I hope I will finish this because my target was to finish this quickly and move to something else. But of course, the important also issue is to make sure you understand why I'm doing that. So let's go to the working number 2. So working number 2, we can easily we can do tabulation, which is a table. We can call it particular. We can say particular, the first column. The next column, we can decide how to call the amount involved in that. And then we see how it can be, and we easily can get what we want from that. So if you check, apart from that, we can easily say this is an amount at that period. And we need to do a column for adjustments because it's an adjustment you are doing. They say it has been charged. It has been charged. Now remember, it has affected 2 areas. They say it has affected the payables and it has affected the income statement. So the 2 columns I'm creating, one of them is, this is the revised. Let's call it this revised. After the adjustment, we have the revised. We can easily call that revised, is it? So we can scroll down here. We pick the particular, we put amount, we do adjustment, we get the revised one. Now it affected interest expense, which is finance cost area, as you may classify it that way. It affected that area. So I need to figure out how it did and what it was. So currently, before I do the adjustment, let's check it out up here. Is it here? No. I did not put finance. I said I'll work it out. I don't know where. Oh, it was 512 at that moment. I think I need to check in the income statement. I have my operating income statement. So if you go to the operating income statement, because we need to do the adjustment. Now the balance sheet is here. The balance sheet is here. Let me also think about the balance sheet immediately because it has come in my way quickly. The balance sheet is this. So you're going to take that figure and adjust it. If you look at trade and the other payables, there is this figure here, and I need to adjust that figure as well as also the other figures relating to that. I think you know the column which I'm focusing on. We are focusing on the column of the 5 GCC because I think it is who borrowed. Is it 5 GCC? Oh, Rick, sorry. It is Rick. It is Rick. It is not 5 GCC, sorry. It is Rick. This affects Rick. So to focus on Rick, Rick was the column on the left side. So you pick that column. So it is this one here. I think this is your left side or your right side, but it's on that side. So it's the one that I'm picking. It is left on my side. So I'm picking this 126 and do an adjustment on it. Now for the income statement, so let's come here and put it before I forget. Because immediately I get it, I can easily come and put it here. So there is payables. It affected also the payables. I could write just like that. And the payables, as you may notice, is 126,400. Now, since it is in the payables, the amount is 85 million, so you need to remove it. You take this minus that figure, is it? And you get that is probably the new figure. If if I hope I pick the correct entire figure, but that is the case, because if you check, that is exactly what should be done on adjustment of that figure of RIC. Now, I'm not seeing the income, but I can switch my data easily here. Let me come here and check the income. This is the income statement. Hope you can see it on your also screen. There is finance cost. Finance cost on the RIC column. This is the RIC column. This is the RIC column. So the RIC column, the finance cost is 89,700. So come here, go take, do the adjustment. I think I have not seen it, but I can come. I have already picked it from the PDF itself. So 89,700. So you charge 85. Take away 85. I've explained the reason why. I'll write the reason also later on. But in the meantime, you take that, you minus, and you get is equals to, I think I typed wrongly. It's supposed to be 85 million. Is 85. So this is the new finance charges. The new finance charges after revise will be that. So you come here and do the respective adjustment. So in the finance on this side, it's not supposed to be that. It's supposed to be this figure here. So you charge it and you have your new figure. In the balance sheet, also, this will be the new figure. So go to the balance sheet. So I scroll back, I go back to the sheet where I've opened the balance sheet, or to the cell where the balance sheet is, and I say this is the new figure. The new figure is that, and I insert it as such. So unless there is any question on that, that's what I'll do.
The 950.
The 950 has no really problem, because if you read the statement properly, if I take you through the statement properly, let me take you through the statement here. If you are not seeing the statement here, they say included in the borrowings, included in the RIC limited borrowings is a loan facility amounting to a franc of 950, which was acquired before the year end, specifically for construction of branch in Musanze. This branch is expected to start its financial operation in mid-2023. Its financial facility cost amounting to 85 million has been accurately calculated and included in the financial, and its related liability has been incurred in the in other payables. So the 950 has no problem. Let's agree that way. Why? 950 has no problem. Why am I saying that? Because they are saying this amount should be start to be the charges in the income statement, because this is when they will start to spend the money. Because when you have a loan, you only charge in the income statement when you start to also spend it. Remember that. So currently they just got the money earlier. They got the money earlier, which is not a problem. You can borrow like today and you want to spend next year. You understand? Let's say you borrow this money in October like today. And then that money you want to start to spend it or to use it next year. So the bank does what it can do and gives you the money. And to tell the bank, I will start to, of course, spend that money next year, but I want it today, or I want it as today. So that's what they are saying here, because they're saying this branch is expected to start its operation in the mid. When they will start the operation, the construction operation, and the financial facility or the money which they charge to borrow the money is 85 million. So that is how we should charge it. Charge 85 later on, not today. I think it also goes with accounting principles, which is accrual system. You don't charge the amount today in that process. You try to charge it as then when you'll have that. You receive the money, they gave you the money probably earlier than expected, or they could give you, like, if you want to spend the money in January, you tell the bank, give me the money. You request the money, of course, in December or in this quarter of the year. Then they give you the money in December. The money hit your account in December or somewhere there. So next year, you start your process of how to spend that money. And that is when you will charge the money. I hope it makes sense to you. Okay. I hope you're okay with that. If not, you can easily ask. So this is our table. Okay. We can move to the working number 3. So I'll fix that. If there's no question, I go to working number 3. Working number 3, let's read it here quickly again. Working number 3, we can come here. It is 5 GCC policy to treat overdraft facility above 15 million of the total long-term liability as non-current what? Liability, as 100% non-current liability. So basically, how do I interpret this policy? The policy here is saying, if you have an overdraft, and the overdraft is 15% and above of the long-term liabilities that you have, then it is better you move it from current to non-current. I hope I've interpreted that in the manner that it is explaining that. So that gives us the room of working number 3, which is this one here. And I think if you check that, that is what we need to also interpret and get what it is. I think it's here also. So we can easily interpret that and understand what it is. So let's go and check our balance sheet and see, is it qualifying to reclassify that loan? It's a matter of classification. And see, is it possible for us to switch that loan or find what we can add, which is above 15%? So it is 5 GC policy to treat overdraft above 15% of the total long-term liabilities or long-term, finances as 100% and non-current liability. So if that is the case, we have to check what is the long-term that we have, and of course, find out if it can easily be converted into that. So 5 GC, this is the column. The column is on your extreme right side, which is the other side, which has this. So at that moment, we need to find out if it is as that element. They say that they take 15% of it and make it to be what it is for that, and which is included in that. So I hope we understand that. So what I'll come here and focus on is understanding it is the group, it is the 5 GCC limited policy to treat overdraft facility above 15% of the long-term liability as 100% that. So what do they have as long-term liabilities? Long-term liabilities, if you may check, it is already given there. So I need to find out what is 15% of that and included it as an overdraft. And that's what I need to do. So let's go here. Just a minute. So if you come down here, I think you have seen the figure, which is there. So what I'll do is this, I can create like a tabulation. So this is a policy of 5 GCC. So policy of 5 GCC is that one. So there's the borrowing. The borrowing is that. So we need to find what it will be. They are saying if it is 15% or 15% of the 5 million to 2 million, sorry, because it's here, the figure is if you may notice, it is here. This is the figure here. You could drag it maybe near here so that anybody who is asking the question would easily see the figure where I'm getting the figure from. So the figure is this one here. Just as I get that closer to me. So this is the figure. So you're going to take that figure, which is equals to 2,582,000 and then 400. You multiply, because they're saying 15% is usually classified. So you multiply with that, and then you get how much should be classified as that. And that is equals to that. Now, when you check into that, you may notice that when you calculate, it gives you that figure. So the overdraft facility that they have, because I brought it here, let me move this away. Sorry, this one here. So they have an overdraft facility. Overdraft facility is 500 and what? And 58,500. So therefore, as we may notice, it is below the figure. So the overdraft should be classified as, of course, the long-term liability. So you should also check that. So checking the overdraft in comparison. There's an overdraft. I'll write these things later because they need time before I send Excel. Checking the overdraft is 5,500 and time is not on my side. So I need to make sure I get that. So compared to what? Compared to a 15% facility, which is said to be 387, 800, 387, 360, sorry, 360. So the 15% gave us that. And what does this mean? The overdraft should be reclassified because interpret again what they were saying in terms of the policy. It is here again. If you check, they say it is a 5GCC limited policy to treat overdraft facility above 15% of the total long-term liability as 100% non-current. So anything that is 15% is supposed to be treated as so we'll add it. We'll add it as such. So we'll take it as such, and that is what I need to add and see what it will be from that case and see what it will give me from that. So the borrowing, we have calculated the 15% above, which is there, unless there is anybody who has a question on that, which is what we got is equal to that. So the question is, according to the policy interpretation, if it is the idea of what we need to do. Now, if it is above, by comparing with this, you compare with the overdraft. Overdraft, if you check, 15% of the overdraft, 15% of the overdraft is what? Is 558,500. Let's see, which gives us 15%, 15% multiplied by what? 500. It gives you that, right? So that's what we have as our figure, and that is what we have as the other part, which is that. So of course, if you may compare, you notice it is above it. And since it is above it, then you need to reclassify. So we will reclassify. We'll classify the 15%, the 15, or we'll classify the 15% as part of the the non-current liability. Unless there's anybody with a question, that is what I'm concluding on. I'm following that policy as for the policy. It's not me who is developing it, it's according to what above, then I of course treat it, because they are saying, as you may check again here, anybody who is checking here, it means I need to classify these. Let me take you back here. It is the, the company's policy, which is called 5GCC, to treat overdraft facility above 15%. So of the total. So I've calculated 15% of the total as 100% non-current liability. So I need to know if you got me. So I need to reclassify that, and I add it to the non-current liabilities. Is it okay? Any question? So anyway,
Yeah.
if no,
Excuse me.
yes.
Me, I think maybe they are saying if the overdraft is above 15% of the long term, that's
Yes.
when you treat as non-current.
Yes, that is true, because they said if the overdraft, if we interpret the question again here, let me take you back here. They're saying it is the 5GCC limited policy to treat overdraft facility above. So overdraft facility above 15% of the total, of the total long term as 100% from that case. Okay, this is, they are saying you treat it as an overdraft facility. What do we mean? The idea is this. Let's understand the mathematical issue. 15% of the long term, which I did, because it means I take 15, I multiply with the long term. Because mathematically it means when I say 15 off, it means I take that, which I've done. And I've easily noticed that they are saying they need to add it as part of the what? Of the non-current. I'm thinking again, and I think it is necessary to understand this. I think again, even if you need, there's no need even of comparing to that. Even this one is kind of useless here to compare with that. It is straightforward, actually, if I interpret that again after reading this.
That is what has been confusing me. He had multiplied it by.
Because they are saying we take, in fact, even we don't need this. I've realized something. We just take what is 15% and reclassify it as part of non-current, because they are saying treat 15% of the non-current liabilities as part of the what? Of the loan, or part of the non-current. If I interpret that properly, it's about English issues. So all of us know English is a foreign language. So interpreting this, which could matter here, it is this, let's understand this again. It is the 5GCC limited policy to treat the overdraft facility above 15% of the total long-term liabilities as 100% non-current, meaning that we take 15% of the long-term mathematically, because 15 means mathematically you take 15 off of what? Of the long-term, and we treat it as an overdraft facility. I think that is correct.
No,
Yes.
no, excuse me, sir. No, excuse me, sir. I think they're saying any overdraft that is above 15% of the total long-term liability. In other words, any overdraft which is above 387, 360 will be considered as a long-term liability. That means the purpose of calculating the 15% of the total long-term liability is to check whether the figure you get will be above or lower than the overdraft facility that is provided in the balance sheet. So, yes, if it is below the overdraft that is given, that means the whole figure of the overdraft will be taken as a long-term liability. And if it is above, that means the overdraft facility that is given in the balance sheet will remain as a current liability.
Yes.
Exactly. So if you are to do compared, I think the interpretation will be that if you are to do comparison, They are comparing, so it means what I was saying was correct because
So I think since you have got that the 15% is lower than the overdraft,
the overdraft
that means the whole of
was
overdraft will be taken as long-term liability.
58,500.
Mm.
Now we that's what was previously what I was saying. We compare that, and if you compare again, we find that it was of course above because this was a not above, was below. It is below. It is below the overdraft. Is it? It's below the overdraft.
Yes.
We agree that
No.
Yes.
it is
The
below the overdraft.
overdraft.
So if it's below the overdraft, we take the borrowings, long-term borrowings, and add it. That is the interpretation which I believe should be correct. The interpretation would be the long-term borrowings, which the long-term borrowings is 2,008,582, if I remember. 400. And then you add now this new 15%, borrowing at 15%
No.
as an overdraft.
Is that so?
As an overdraft facility, which is the 15% should be, you add now this 558 as a part of that. Is it not that the case?
Yes, I think it is.
That's the
Why
case.
are you calling the 38 the 50%?
It isn't 15%.
To be calculated basing on
The 15% was just helping us to know if it is below or it's less. It's above.
We can call it let's call it just overdraft.
Yes.
The question is
overdraft only. Overdraft is, there's no need of putting 15% there. We can call it overdraft facility, and then we call this total, which is, I think if I link that, that could be making sense. Let's call that total, eh?
Yeah.
That makes sense this way, instead of calling it overdraft, because it seems like it's confusing when I put overdraft there. I'll just call it I'll not put 15%. I'll put it as it is. I think that is the proper interpretation of what I have noticed, is that they were comparing. If it is below, then they have to treat it as such, and that is what we have agreed on. If you read the sentence properly. So
for me, I have a problem about the 15%.
Yes.
Are we to calculate the 15% or it is given to us?
It is we see the 15% we did not calculate it, we were given. It is here. So the idea was they were trying to say if it is above 15%, they treat it as a what? As an overdraft facility. Meaning if it is below the 15%, they treat it as a what? An overdraft. Not an overdraft, sorry, as a long-term liability. So there are two options here. They said if it is above 15, they treat it as an overdraft facility. Meaning the opposite is true. If it is below 15, they treat it as a what? As an non-current liabilities, which is what I was doing. And in that case, 15 was given. I did not calculate it. 15 was given. So we calculated this, which is here. And we compared it with, of course, the figure which was there. And of course, we found it is below. And since it is below, then we decided that we need to, of course, this one here, this figure is below. Now, since it is below, then this overdraft is supposed to be added here and become part of the long term. Because they said only it has to be 15, and above to be treated as a what? As an overdraft. If it is below, then you, of course, treat it as a non-current liability, which it was below. What was below was because this 15 we calculated is 387, 360 was below the 558, 500 of the overdraft. And that's why I say it is below The overdraft,
Yes.
Harrison,
How did you calculate the
we should add it.
387?
Eh? What?
How did you calculate the 387?
This one here.
Mm.
This figure here and multiply with 15. You can do it with your calculator and you see. I hope I've correctly done that. 252, 400. I multiplied with 15. I think if you multiply, it's the same. I hope it is not wrong. Yes, it's the same. It's the same if I just multiplied and I got that. So that's what I got. And then I compared and I found it is below. Now, since it is below, we decided to pick that direction, that it is supposed to be reclassified or put as part of the non-current liabilities. So a non-current liability will have that. Unless there's anybody with a question on that, that's what I did. According to that interpretation, they have said it. I think my interpretation is making sense, and we agree, because even I saw some people agree with that. So if you agree with that, that is the idea. So working number 4, if that is the case, let's finish the workings and then we go to the balance sheet later, so that I focus on the workings quickly. Now, working number 4 is supposed to be on, if you go back here, if you check here, there is a note 4. Note 4 is about depreciation. All we need is to reclassify. We need to reclassify, and this is what I need to focus on, this part here. It's about depreciation here. So I'm going back to the Excel and reclassify. Remember, they are using what is called what? Reducing balance. So reducing balance, it means the adjustment is easy. I simply deduct the straight line and add what? And add the reducing balance. Is it true? That's what we need to go through and see what it is. So if you come back here to the Excel, that's what I need to do, and I check out, and that will be the next agenda that I need to have for this. I don't know where I saved it, where I placed those summaries of that, but I think you'll assist me with that figure. I could easily not remember how I put it. I think it was this one. I think it's this one. I need this table close to me because, you know, the data was too much on that question. So I need to bring what is close to me here. So this is close to me here. I need to fix this depreciation issue. Now, apart from that, I also need to fix operating expenses. So if you find out where there's operating expense, you can let me know. Operating expense is here. So I may need just to drag it a little bit, maybe with me. If I drag it here, I could just drag down here and I have it closer to me. So operating expense is that. So this will assist me to solve working number 4, because they said, why am I saying that? Because they say this is included in operating expenses. If you check, they have said it is included in operating expenses. So I need to adjust operating expenses here. They say included in operating cost, it is that. So let me deal with that, and then I see what I can do for that case. So both Rick and 5 GCC have that issue. So this is Rick. And then I need a table header for who? For 5 JCC. So I'm supposed to adjust my operating costs. So I'll start with it, first of all, to just mention that what I start with first, because the adjustment will be done on that. So operating cost, if you check, we have 9, this one here, it is this one, 9,424,000. And then on the other side, we have 564,892. So you need to less the depreciation on straight line. So this one is on straight line, straight line method. I'll call it SNL, or you can call it SL. I'll just call it that. Then I need to get here reducing. So I'll adjust here using reducing. I don't know how to shorten reducing, but I can call it reducing basis. So I'll add that. So I remove that to add the appropriate one. So where do I get the figures? They are here. The state line was 3,750,000. So that is supposed to be less. So put a minus on it and supposed to less that. On the other side, I'm supposed to less as you may see there. And then on this other side, I'm supposed to add 2,250,000. And then on the other side, I'm supposed to add 4,590,000. So if you do your analysis, you get this to be adjusted. If you do your analysis, that will be the adjustment. And that is what we may call adjusted OPE or operating from that case. Let's call it operating or OPE. We can shorten it operating, adjusted operating, which will be that. And that is what we'll have for that. So that's the new figures we'll have. So we can come and we'll post them there later on as we go through that. Now, let's finish the workings first, and then I go to the statement, because moving up and down is bringing some problems to focus on my focus a bit. I need to focus on finishing one part and then I move. Now, this one doesn't affect the income. I say this one is on analysis issues. And then credit sale and black, this one, all these don't affect. So note number 5 and 6 and 7 are only for analysis, because we'll do ratio later. So it means they don't really make workings for what we're doing for now. Maybe later. So we can go back to the Excel. I think our adjustment is done, or our adjustment is finished. So if our adjustment is finished, let's fix all that. So our operating here has changed. So we could link it to the new figure in our workings, which is this one here. And subsequently, also this other one has changed, is no longer 11.5 and something, it'll be 12. So that is what has changed there, is it? I think this one I've changed already. We did in the workings, so I've changed that. Also now operating, I have to indicate that I have done it. It is not the original one. It's a working probably number 4, which has fixed that. And this has been done probably in working number 2, somewhere there, which we have fixed that. So that is what will be in form of our income statements. That is what they will have. I think there's nothing much for me to do there. I can go to the balance sheet and see what the balance sheet is supposed to also have adjusted in terms of that. For inventory, I think inventory was the one which needed the working. If I highlighted that as it needed the working, inventory, I'm supposed to have now the new figures which were under the LIFO, not the LIFO, the FIFO. The new figures which are under the FIFO. And the new figures which are under the FIFO, I think if you check, they should be the ones which we have here. I should have 811 and I should have 486, which I think is exactly what I have. Let me admit somebody just a minute, which is exactly what I have. I have 486. Yes, and I have that. So what else was I supposed to fix apart from that? With the inventory, I think that's probably, there is something I was supposed to fix on the borrowing. Now the borrowing, I'm supposed also to fix it. I think if you go to the borrowings, also there was something I was supposed to adjust on it. And let me check if I did it. If you go to the borrowing, especially on the payables, I think this one I fixed it already, and this remained the way it is. And of course, we need to check now. The overdraft will be that. This will be removed, so it will be 0, because it will be reclassified and be brought to the non-current, and non-current liability was here. So non-current liabilities, if you check, if you go back to the question here, it was only affecting one side of the issue. So this will remain the way it is, but this one will be affected. So we'll pick that 1,801,900, 1,801,900. So if you come here, it is 1,809,100 before I forget it. So that is what it is here. On the other side,
It
Uh,
is
we
81,900.
Hmm?
It is, yes, one
One.
is 900.
Oh, 900. Oh, I interchanged that.
Mm.
So it's that way. Thank you. So the other side, if you go back down here, if you link it, if you scroll down, you'll find it is this one here. So this is the adjusted one. We reclassified. We reclassified, of course, after understanding that rule, we had to reclassify it as such. This one also was adjusted, so we already fixed it. And this one remained the same. So we already fixed those issues. So now let's go back to the current. I think they're okay. Let's go back to the equity section. Because as you notice, they're of course having some differences in that. So we need to check the equity. The equity, that will remain, nothing affected it. This of course will be as it is for that. But retained earnings, I need to find out what has transpired in that, and I find out what will be the new figures that we have for that case. So we have profit after tax, which is already that. So what we needed to do was to find how the retained earnings moved. So if I was to find the retained earnings, if you go back to that question again, let me come here. I hope you could get that. Previously, this was the figure. Those who are doing reporting, they know how we do it. Actually, this is like I'm doing reporting almost. So if you come back, this was what was reported profit after tax. I'm assuming there was no any other expenses because it's not given. So if there's no another expense which is given, then it means if you subtract this from what is reported in the balance sheet, you should find what was the opening, because this was for the year. In the balance sheet was this one here, is it? So let's subtract and find out what was the opening, because I need to add the opening. I don't know the opening yet. So if you have a calculator, you can subtract that. Or if you don't have, then we can do in Excel, no problem about that. So we have, this was what was reported, 1 million overall, 344 something. It means they were making losses previously, because how can you report profit this time and still you are in the whatever is reported is less than that? So they were making losses definitely in the previous years, is it? Here it is 3.8 averagely, or 3.9. Here they made 7. 7 is quite a big figure compared to this. So there is a big figure of a loss they could have been making in the previous years. So I need to use those figures. And once I use those figures, I can easily know how to get my data of what was the profit for that. So it's almost like that question required knowledge of course, financial reporting and a mix of course, the other issues. Of course, these topics are interrelated. They are all management courses. So they all affect issues of management cases in terms of that. So if you go back again, I think you could assist me with those figures. I need to calculate my new retained earnings as it is. So the retained earnings was the issue here. Retained earnings. I didn't think it was it could have been an issue, but I realized it's an issue. Retained earnings, there is a balance. There is a balance brought forward, meaning the opening balance, the opening, which I need to find out under the two companies, which is of course the RIC and then the 5GCC. So I need to get that. And then I need to get for the year, FTY, I usually call it like that. For the year is there. For the year, no problem. I hope there was no dividends or anything else which is missing. So for the year is that one. We'll go to those. So therefore, it will give me now retained earnings that I should report overall as current for the future. So to get this, what I was saying again, if you check in that question, you'd realize you may need to get that. Now, how do you get that? You have to get what was reported and subtract what is for the year and what is for you subtract between the two. Find the difference between the two and get what is the difference. So, profit is always accumulative. So accumulative mean is added, or it is a plus to others, which is led to that. So we'll get that profit. If you to get that, I told you can come back here and you pick it from here. The profit was 1,344,871. That is what it is. 1,344,000. I think you can write that. Let me write in the calculator. 1,344,000, and then you had 870. So the year was 3,522,239. So there's that difference. The difference shows is a negative. The difference shows is a negative, and that's what you have. So you have 1,344,000 and then 871 minus 3,522. That is the tricky thing that was there also, because you need to calculate that. You need to calculate what will happen there. I need to find a new one. So 22 and then 239. I hope I've written correctly. So I get that. And if I run that, should be able to give me, hopefully that is the figure that we should have here. So we should have that figure there if that is what they made previously from that period. So we have all that, but still I think there is a big difference between that. We'll find out later on what causes it. So anyway, here again, I need to find what was the opening. And if you go back, you could check what was the opening here. The opening, as you may notice, it is the difference between this. They reported a profit of 3,866, as you may notice. And then there is a 370. That is the profit they reported. But the profit they had for the year was 7,249,143. You get that? So if you go back here, you could fix that also too. Because as you may notice, they had 3,000,008. 3 million, was it 8 something? I forgot that. Let me check again. Just a minute. Yeah, 3 million, as you may notice, that was the figure, 3,866,000. So that was the figure that they had from that. So bring it here and you fix it also there. So just a minute, my computer wants to switch off. Let me fix the charger. A few minutes. So 388 and then 66 and then there was 370. So that's what they have as reported. I think I put too many zeros, which is there. Is it correct? Check for me. It is here. It is okay. There is only 18. Sorry, there's only 18. So subtract the one that was reported. The one was reported was 7. As you may notice, 7. Just a minute. 7249143. So if you subtract, I get that the difference. You'll confirm if I'm correct with that, because I'm just checking to find out if it is that. So here we needed to have that. If it is that. Now, this is with the total liabilities. This, this one and this one should be the same because it's the total assets. Oh, take away liabilities, which I already added. I took that and took that factor into it, and I should be getting that. So plus this, then it should be able to give us that. I don't know why there's a difference in terms of that, but I'll check. Let me confirm if it is supposed to be that way and see what it is from that angle. This is this plus that, and this is this. Of course, we have a summation of all that, but this one here is summation of this. Let me check if my formulas are working. We did this last week, so I don't remember if my formulas were all intact from that case. So this is the case, and that is the case. So this is what it is. For the PPE, there is something we have not posted. The PPE. The PPE will have different figures. I think I've noticed what you have not posted. There's a PPE. PPE, there will be 700 and this 7 million, sorry, 500,000 that is the figure. You need to add this. You need to add, I think the PPE, where did we adjust the PPE? Here. We're going to add this figure and then we subtract the other figure because that is what we need to do. We add it and subtract the other figure. So to add it, let me use minus because it has a minus down here. We add it here, but in the process, we also need to plus. As our case is that we need to add it, so it will be plus. So we need now which is the correct figure there, and that's what I needed to do for that case. So I had not factored in that. I think I've done correctly because it affected the PPE. Or we can do it here before we move it to that side. The PPE is 7,700,000. That is the PPE. And I think that is the figure we have. On the other side, the PPE is how much? What is the PPE? Those who have the figures. The PPE on the other side is 18,900. So 18,900. 1, 2, 1, 2, 3. 18,900. I think it's a correct. Somebody's asking a question. Yeah, exactly. That's what we want to adjust. You're correct. We needed to adjust PPE. So PPE is equal to that. So we need to add what was initially deducted or previously deducted. So what was previously deducted, I'm going to add back because to cancel what has happened, they subtracted. So to fix that, I do the opposite. Is it? Mathematically, that makes sense. So I do that. I get also this one will add that. Then I will now less what they believe in, which is the reducing balance. And the reducing balance is now those figures. So I reduce those figures as such. I reduce that figure as it's expected as such. So I hope we are together on that. Then I add this and I get this is equals to that. And I add this and I get that is equals to that. And that is what we need to post here, which is also what I was doing here. And we can now pick this because I've already calculated down here again. You can come and pick it as such. So I've not fixed that PPE. I think that was also maybe one of the issues that we have. So we have a slight difference. The difference has reduced a bit. There is a 475, which I need to find out what cost it. Probably
Can you please check on the inventories? I'm concerned.
I think inventory is 486, it's okay. And this one is okay like that. Unless I posted wrongly inventory, let me bring it closer here. This one was okay, they were using FIFO. This one we have to fix it, which we have fixed it. This is 105 receivable, I think we did not adjust anything. 7 days, 89 that. And I think here that should be the case, which should be here. Because previously this was 736, 800, which was giving us that. But now I've adjusted, so it is supposed to be that way. Then this was okay. And this was okay. Nothing affected it. This was okay. This is okay, which is equals to that. And you add now this will just this one here, you get supposed to give you that. That's okay. Let's check one by one. This one here, it's okay. Nothing we adjusted here. We adjusted nothing. So it's supposed to be equal to now the new figure here, which gives us that. For the other part, it is only the asset which has changed to this, and this has changed to that. This had this one here, which is intangible assets, which is equals to that. Then come to the liabilities. The liabilities, this one will change, this one will not change, it remains the way it is. And this one will change by eliminating that figure, and this one will change by eliminating this, and this one is equals to that. Remember, this is okay, this has been added here, it's just moved there. So of course, if you check, the totals is of course different because if you check, the total was 136, 137, sorry, 600. If you minus, I think the difference is not just that what adjustment. I want to find if it's the adjustment exactly. If you minus this, you get this the difference of 85, which is correctly. And of course, in this case, this should be able to add up when you add the two, should be able to give you that figure. And this, when you add up the two, should be able to give you that figure. And then total of the two is total assets, subtract all total liabilities, you get is equal to that. And similar to this, you subtract this. And then this is the results was that way, which is X. So we have, this is 500, this is 5 million, sorry. This is equal to that. Would not affect any results, is it? And this remained the way it is, as it is. And then we have adjusted this and got that what it is. So there is a difference of that, which I can't relate to where it is coming from, but I could easily check, maybe it is coming from the retained earnings, because the retained earnings is the only thing which also we adjusted. Retained earnings I've checked again. Let me check the retained earnings, if I'm correct, because the retained earnings were 344,871. We subtracted the other figure. If you check, we subtracted the other figure. And what is the other figure? We subtracted this other figure here. 3,522,239. I think I got that correctly. Is it? Check if it's correctly done. Yes. 3 million, which is already there. So I think I've correctly done that, unless there is anything which I'm not.
Excuse me, where have you got this one for the year end? 4.6.
For the year end, 4.6. 4.6. 4.6. We have it here. We calculated it is this one here. We have calculated a new figure. Our new figure is this one here. Our new figure is here. I think it's correctly done. If you check, it is equals to 4 million and that, which is correctly, which I just posted here, and this. So plus that one, and if you check also this one, I've done correctly, which I think, unless if I did wrongly, but let me check again, because the figures. I took again here, let's see, 3,866,375, subtract that figure, 7,249,143, which is what was reported as, if you may check here. So again, I think I did all those correctly. If I check here, let me check again here. It is 7,249,143. So 7,249,143 is what I've subtracted here. I got that. So I needed to update the profits, because the profits, you see here, I have accumulative. This accumulative, as you may notice, it included this one here. So my intention is to subtract this, because we have a new one. So I remove it, this one, and add a new one. I think you get the point, eh? Sorry. I removed it, which was actually 3,522,243. So I removed it to add that. This one is the new one. Also here, if you check, my intention was I take this, I remove this, and then I add that, which was supposed to give me that. And then therefore, the new values are these ones, because it means previously they were making losses, which I added here.
How do you calculate that profit for the year?
Profit for the year is automatically calculated here, because we fixed it here. Here. It is this one here. We adjusted the figures. I think the previous time we made even the format here. We took that plus that, it gave us this. This one you have adjusted. I think if you check down here, you notice is this one. If you go back, you notice it is this one here. So you see it's that one. If you go back also for this, you notice is this one here. How did we do that? We took this, we removed the straight line. Straight line, I think, is still here, and it is okay. And then we added the reducing, which made this. And if you go back again, you check, you notice it is that one there, which gave us that. Which in total, it gave us now this. And this one gave us this. So when you come back here, we got profit before tax, which is, of course, the total, subtract this, and that subtract this. Then there was the taxation. Taxation, I think nothing happened on it. So you just needed to tax it, and you get is equals to that, and you get is equals to that. And that is what the new revised profit should be, which means those profits are the ones reported for the year. So what I needed is to find what was the previous year. I took this and subtracted that and got what was the previous year. And I took this, subtracted that, and got what was the previous year, which I got some negative figures. Then I added this, I get the new profit, and I get the new profit for there. So either the person who said that maybe the question, I don't know if there was something which did not factor in, but inventory I think is correct. We have fixed it correctly. This one is correct. Receivable, I think everybody could say receivable is a 189,650. There is this 129 and the 254 and all that. So it's correct. All are correct. So we have revised. Now we can do our ratios. I will check the difference later, but it's possible to do now the ratios of liquidity and the rest. Unless there's anybody who still have maybe an issue somewhere. In 1 hour. Now it is almost it's almost 8:15. I was planning to do ever return on investments. Now the question is taking almost the whole lesson. I wonder if I'll ever do that one, but let me move on. Okay, the idea is that one. I think if there's no question, we can move on. There's differences. I've agreed there's differences. I'll have to investigate what caused those differences, because as per now, I don't see where the issue came from, because I think we fixed everything correctly, unless there was any figure that we did not fix correctly, which you may notice. But if you check properly, all the figures are according to what was to be adjusted. There were only 4 things we needed to adjust, and I think we did that adjustment properly. I'll check either sometimes maybe there was an issue in the question and the question even wasn't balancing even before this question. That could be one of the cases, or there could be something on our side which we did not factor in properly. But I think if you check, if you see this is factored in properly, this is factored in properly, this gave us that, and all those cases are also factored in properly. So it means we are correctly done, or we have done what we need to do, unless otherwise. If it is other issues, we'll investigate later, because currently we don't have time for that. Anyway, we can calculate some ratios just to do the analysis, because the question needed ratios, and then we at least summarize and move on. So we can do some ratios analysis. If you have no question on that, you can add with your calculator to confirm later on. But before I send it, I'll make sure I understand what caused that difference, because as for now, I can't see it properly unless I sit down and cross-check it to find what really made it that issue. So we can calculate some ratios which you can use to do the analysis, because the question also required, if you look at the question required the students also to do analysis on it after revising. Revising was just part of you making sure it is now according to the market. Here, there are 2 things which were being asked here, and 5GC Limited of each other, and also against industrial average. So I want to do against industrial averages and then discuss and recommend what I could do. So let's compare with industrial averages. So come here. We can start with what the industrial average is offering. Industrial average is offering this. Let's bring it close to our analysis. Probably I could push some things behind it and bring the industrial averages. Industrial averages are these. So I can customize my analysis based on that, so that I avoid doing too many, because there could be too many analyses I may have in the head or we have available. But the best way maybe to customize according to the required is let's have the industrial averages being brought here. So the industrial averages, number 1 is the current ratio. Current ratio. So current ratio, if you check, its industrial averages is 2 to 1. That is the common industrial averages. So I'll say that is industry. And then here, there's what I need to compete for RIC, and then for the 5GCC, I think it's 5GCC, something like that. So I need to compare that. So let's calculate. To calculate that, we can come here. We know the current ratio how it is. Current ratio, you pick, of course, the current, which is this one here. You divide. That is the current assets. You divide by the current liabilities. Current liabilities that, and if you divide, you find it gives you that. Is it 18 times? Really? Let me see. This is current. Yes. Divide by this. Yeah, it could be 18. So it's 18 times. That's quite good, or maybe better, or maybe you are holding on so much things because the average is saying that. So there could be either, if it's under, there is issues. If it is over, of course, there is issues. You know, in life, we try to fight for balance. So anything excess is also not good. Anything also under is also not good. So balance is always, what is the balance? So again here, for the current.
Excuse me.
Yes.
So you are using the data of the updated one.
Yes, I have to.
Statements.
Yes, exactly.
Okay.
Actually, this question required you do update first. Then you do the analysis. That's what was the issue about it. You need to update first. You need to update first and then you do the analysis. The analysis could not be done first before you do the revision. So you take that, you divide by now the this one here, and you get that will be 10 times. So that will mean the companies, you can comment here, many comments you may want, but of course the figures will give you many ideas because we have 18 and 10. So comment in that regard. Then come here. I think if there's no question on that, I think you have seen where I picked the figures. You need to revise to make sure they are on the same platform. Make sure they are the same as the market. That's what the idea why we started by revising. If there was no revision, I would have easily gone to the ratios immediately. Actually, I've not even have wasted time to focus on that. I would have easily gone to the data immediately and sort out the ratios by putting in. But the question wanted us, actually, which has taken us almost the whole lesson, because we had started last time, I thought we'd finish in the first minutes we do, but it has taken us also another time to finish that. So it means that if you compare that, you'll find what to talk about after you do the revision. So that is 18. You will advise on the basis of that. You will say maybe they are holding too much, because also holding too much is not good, because you remember it is supposed to be benchmark 2-to-1. So if it is closer, better. If it is, because this means is 18-to-1. And 18-to-1 means you may be holding on a lot of money or holding on inventories that is not moving. That is also dangerous because you realize the numerator is bigger. And the numerator is bigger because it is the current assets. And the current assets are made up of inventory, prepayments, and that. So there's a lot of maybe probably money you are holding on or stocks you are holding on that are not moving as such. So you may review your stocks and maybe reduce your stocks to invest that money somewhere else, or you may review your prepayments, or you may review your cash. Maybe you have a lot of cash that is idle. That could be some of the issues you may explore as we go through that. But that is the idea here. This one is equal to that. And I think that's what it gives us. It's a ratio is equal to that. So you could explain in that angle. Then the next is return on capital employed. As you may know the formula, you remember the formula, we went through that. You take the net profit and use it to net operating profit, or what is called EBIT, and then you use it as a basis of dealing with that. So you can go up there and pick it up and use it. So it is, the profit is here. So the operating profit is this one. I could have calculated this. It is before finance, so I did not calculate it. Let me calculate it. I think that is why usually I like separating this, because now this analysis requires we do that. So you have to take all that cost and then you separate it. You could calculate it before, or you can calculate it under the formula, which means you take summation of this, you have that, you take also similarly to the rest, which is this one here. Now we needed, of course, what is called EBIT, which should be, of course, this minus this, which is will give us that. I think we needed that. We could have developed that, but we combined finance cost and did overly. So of course, this one will not be the same. So this will be, of course, dragged just to be focused on that area. And of course, similar to that, we'll focus on that area. And I think 30% will be reviewed from that position. Let me see. Now that this one must take a negative to initiate issues because of what it is here, and this must take a negative because it is like it is plusing from there. It changed some things here. So that should be the case. Oh, here also should change. Here it should change from this area. I think I did some issues here. This, why is it not the same? Yeah, there are some cases which I did. This one should be positive, because this is now profit. Just a minute. I check why the Excel is not adding properly, unless you see that. So this is the what is called EBIT, or operating profit, or operating profit, another name. In those who covered FM, maybe it is called EBIT, which is also the common name used here. So it's operating profit. So operating profit is that. So if you take, let me see why it is. Oh, I put a negative. That's why it is this plus that. So that's what the issue was. And then, of course, this is similar to the rest. So then the taxes, they should be giving us this figure here should be the one also. This now should be operating profit again. No, profit before tax, PBT. PBT, profit before taxes, which you can bring it here again. You tax it, you get the same. Huh? I think that should happen to this also, similarly there. And I think this should happen to this also, similarly here. So it's to say, I think it's okay, or it's similar to what we had. So anyway, I needed to calculate that because it's supposed to be used here, or to insert that. So because it is supposed in capital, the capital invested, of course, we calculate what is called return on capital employed, which means you take EBIT, you divide by capital employed. Now, capital employed is equity plus long term. So the equities are this one here. Now you need to add the long term. Long term is this one here. So you add the long term, and then you close the brackets, you get it should be something like that, 65. So you remember how it is. It is EBIT and then divide by capital employed, those who remember. And then next is the same pattern. You will take now this figure here, you divide by, this is the equity. I think this is our equity is equals to this figure here, which is it that one? No. Equity was that. But you need to plus. You need to plus the long term. Long term was that figure. So you plus the long term, and long term, because it's similar as return which is equal to that, return on investment, the investments are that. So you do that, you get that is your figures for what we have. Unless there is anybody with a question, that's how we'll do with it. We take that, this, I think net asset is of course involving equities, if you check. So I think I've picked correctly. These are the equities. And with the equities are, owners, what the owners have invested and what you borrowed, which is this one here, which is called capital employed. So you pick that and you add, you get this. Similar to the rest, also you pick this and that, and you get is 51%. You could advise on that basis. Okay, next. Also, we can move on if you don't have a question. So next is, we are still benchmarking on this. Remember, the industry, sorry, I put on the wrong column. I should put here. I wanted to put the industry figure. So the industry is 45%. So all of them are performing well based on the industrial benchmark. They are above, this one is above by 20%. And even it has, you can quantify in percentages because you may notice that it is equal to, of course, if you compare, it is equal to this minus this, it has 25% divided by originally where you are benchmarking on. So it has 43%, which is not bad. So you may talk about that and say it is not performing, it is performing well, and it has like almost 44% better performance than this industrial. And even the other one, you could notice that it is grown on, or it has a growth or some percentage of incremental, and divide by actually the 45, and you find it is almost 13% better than the industrial performances. So it's not bad. I think we can move on. Unless there is anybody with a question, we're going to the receivables. So for the receivables, I think you can notice, if you forgot the formulas, I think I already shared the slide, which you could see that, but I can also remind you. So the receivables, you needed also to come and talk about the receivables for that case. So the receivables, the collection, they wanted the collection average, collection days in average. Those who are doing managerial or strategic of corporate finance, maybe this is some formulas there which are popular. So you remember, of course, how we deal with that. You will take, of course, the receivables. You take the receivables you have, because you want to get the receivables, and then divide by credit sales per annum. So you divide by credit sales, because they come from credit sales anyway. They're extracted from the credit sales. So you do what is your credit sales. And then, of course, the credit sale is usually per year, because it is benchmarked on an average of a year. So because you want to find in days, so you'll multiply by the figure of all of these. After you divide and find the issue, you need to convert in days. So you'll multiply by what represents a day, which is 360, which is a year, a day, days. So that the years and years will cancel out, and then you get what represent a days. So to fix that, first of all, on average, they have said it's 35 days. So let me put that before I put wrong data there. So go to the figures here. Is 650, that is the figure. Or you could, because I'm using Excel, maybe in future I was told that they will introduce computer-based exam. So divide by the credit sales. Now, credit sales, remember they said credit sale was 10%. That's where I say to be used. So take 10% of what was the overall sales, which was this under RIC. And sorry, I think I did very quickly. Let me see. It's supposed to be 10% of this figure here. So you get that, and it says a 0. So of course, maybe it's a very small figure. Why is this saying it's a 0? Let me see if I increase this. Oh, it's not really a 0. So I divide that. I need to convert that to days. So they said we assume it is 360. So it give me like average of 30 days. And let's say 31 days, approximately 31 days, which is not bad, because if you can be able to collect your money earlier, the better. It will save you from borrowing. It will save you from borrowing money from other people, or a cost of borrowing money is expensive. So it will save you because you'll have money. So next is also the similar pattern. You pick also, of course, the receivables, which is equals to that. You divide by 10%. So take 10% of the figure. 10% of the figure is equals to that. Close this. And then you get what it gives you. Of course, it's kind of also a point over something, but you need to convert it to number of days. That is 360. And that is 11 days. And that makes probably much better. So you'll comment on that related issues. You'll comment on that related issues. Accounts payable. Accounts payable also similarly, you'll do the same. You will take, they want the collection of accounts payable. Now, industrial averages, so it means they're performing better anyway. Most of the issues there are performing better. So industrial average is 30 days. Now, most of the time, people want to delay payment to use that money, especially payers or people who are paying. They have that habit. Usually, you know, if you are the one receiving, you complain a lot because they're delaying the payment, but their strategy is to hold on the payment to use some of that money to run their operations. So the longer you delay, they feel that is better, but at the same time, remember you need also the service. You may delay and also kill other services. So it's averages and the optimal matters a lot. So the same case here, take the payables. The payables are these ones here, and of course divide by the credit, you know, credit purchases. I think credit purchases, it is not in my head. I don't remember it properly. That one will force me, I go and check here. I don't remember it properly, but I think it is said credit sales was 10%, credit purchases were 500 and 200 and 920. So this one was given in numerics. This was given as a percentage. That's why I used it. So we get 500 and the other one is 920. So that one has been given in numbers already. So this is 500. I think all the figures you have to add plus 3 zeros because they were in thousands. So you will get what it should be from that extent. So you'll divide by, let me count the zeros again. 1, 2, 1, 2, 3. So it is equal to that. Then you get that, you multiply by 360 days. And it is 30 days, and that's similar. You just say it is enough, it is adequate enough and similar to the market or the industrial averages. So there's no big deal about it, but they should be careful not to be, because it's on the margin or on the edge. They should be careful not to let it exceed beyond that, or maybe go beyond, be somewhere. You know, you can comment on its repercussions later if it goes above or under. So anyway, the last one is this one here on the payables is this. So we divide by 990, add the 3 zeros, 1, 2, 3, and then you get that. That gives you that. So I want to put this here so that I close this, and then I multiply this by 360, and that gives me 40. And you may comment on 40. It could be better if they delay, of course, by 10 days. It means they're using that, they can use that money. Here, it is almost it's close to the other one. So there's the impact. So next is the debt ratio. Now, debt ratio, mostly debt only comes as an issue if you are doing debt to equity ratio. There is debt to equity ratio. Now, that question was not clear. What debt ratio? They didn't say. They didn't tell us. I could easily say what is debt ratio, because debt ratio should be debt to equity, debt to asset, debt to, you know, most common is debt to equity, and the other one is debt to asset. So debt to equity is always written like that. So they are saying on industrial is 20%. So let's compare that. That is a leverage aspect. I think we'll get that and use that later on. But the equities and the debt here, of course, we take the long term, not the short term. The short term can always be paid anytime. So you take that and you divide by equity, and equity happens to be that. And that could be converted into percentage-wise, and you get multiplied by 100, and you get is equals to 21%. And that means you easily have your figure as that. Next is this one here. The debt is, of course, this figure here, divided by equity. Equity is equal to that. And since you have that, if you multiply by 100, you will get, it gives you that, and that is 19%. And you say, of course, this one seems to be higher than industrial by 1%. This is, of course, difference of less by 1%. So you could communicate on all those cases. Unless there is any other question, because the subsequent question is asking, you recommend on those cases which are relating to here. Discuss key areas with the recommendation that the management of RSIC and 5GCC Limited need to address to improve the performances. So you could say, what are the areas they need to improve the performances? But remember, it is not limited to the ratios we calculated, but it is part of most of what we have done, which may need to have comments here so that you get the 30 marks you need to comment on those issues to get another 5 marks to make 30 marks for that. So that's the case. This one is about governance issue. I think governance is a strategic issue. Some of you covered governance also in that area. So that is the case that question required us to do. Now, unfortunately, I never planned for this question to take us that long, but that's the case that it has taken us. Others are merely comments. Comments, I think everybody has something you can comment on. And always, when it comes to comments, as long as you can support and have the evidence, which we have been doing, the evidence is this. So if you can comment to complement the evidence you have, then always you can never lose the marks because you're supporting figures with the words, which you also can always have a fact to what you are doing. Any question? Because I've talked a lot. Maybe you can ask a question.
Excuse me.
Yes.
Now the the question I have, probably when we are like in a class, you give us like the template of how to make that report. What they are saying, write a report.
Write a report. Okay, so actually we are discussing about this. Performance always comes in exam a lot. So we will try to like maybe we can see how to balance some units of performance we do in class physically. So I'll do that when it comes to that time, is it? Is it okay? We can create time to do also some performances in the classes because performance, if you check statistically, performance never misses. Whether it is transfer pricing, whether it is a return on investment, whether it is a divisional performances, which is return on investment and the rest. So I'll give it, no problem. I'm trying to make sure like we get time to do those in class. Maybe we'll see what you can do and maybe use that as a way of dealing with this. Any other question? Any other question? Because I think actually I was intending to do, other things, but I think it's almost like it's going to be impossible. I never thought it would go to that extent because I had also wanting to do what is called EVA, but now it seems like I can't do anything because of that question. Anyway, it was a long question. If you check, I think it was not a short question. It was requiring adjustment and then doing the analysis. So it was not a short question. Question? No question. So if there's no question, I'll add the comment. I'll also put the format which you are asking me. I'll put the format of how to explain those issues because here I just need to get the explanation of the data that we have done. I'm also going to check because I noticed our balance sheet had these differences. I'll check if I posted the figures correctly because this difference should not exist. Here it is 8 this, here it is 8 that. So it means there's a difference on the other side. So I'll go and investigate that before I share the Excel. I'll make sure I fix that and then I can share the Excel with the respective data and other notes relating to that. Unless there's anybody who has a question on that, I would wish to stop there because I was thinking I'll do EVA, but I think I can't do EVA. Maybe in the future, we may request to have maybe 2 classes online because it seems like one question sometimes can take like the whole session explaining and doing, So maybe we'll have to discuss and see how we can also add maybe more hours because one of the biggest problem has always been time. Time is always a problem. So if you can find a way of adding maybe more hours, maybe we can always discuss that and see how to finish this because we want to finish this probably as October. You remember we have only October. So November is usually some few days here and there. So we need to try to finish most of the things in October so that we can easily have enough time for revision. So we'll discuss about that. In the meantime, if there's no question, I want to end it there. So good night and thank you for coming.
Yes, good night, sir.
Okay, thank you. I'll share the data later on.